Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding members of the Dividend Kings marketplace site on Seeking Alpha. And with this particular FastGraph Friday Analyze Out Loud video, I'm going to take a look at the mid-cap company MSC Industrial Direct. I like this stock for several reasons, which I'll be covering in this video, but I also want to point out that there are some, potential pitfalls that I think prospective investors should be aware of. The company was founded in 1941 and has been listed on the New York Stock Exchange since 1995. It is considered a leader in what is a highly fragmented industrial distribution center. The company offers over 1.6 million SKUs that they get from over 3,000 suppliers, and their really value-added proposition is in metalworking expertise, but they also provide a great deal of insight into supply chain management, e-commerce, and productivity improvement and training for their customers. But with all that said, it is an industrial. And what I want to start out by looking at here is the company's adjusted operating earnings. And what I want you to see is that the company's adjusted operating earnings growth rate has been quite attractive at over 10% going back to 2000. But it's also been somewhat lumpy. You can see earnings were, a little bit weak as we went through the 2001 recession, but then they grew very nicely for several years. Then we had a, rather precipitous drop in earnings, over 34% drop in 2009. The company has a September fiscal year. And again, that was followed by some strong growth. And then they had 3 or 4 years of rather weak earnings, followed by strong growth. And then more recently, they've been missing their earnings estimates, but they are still expected to generate moderate growth going forward. But what I want you to see as it relates to this particular earnings generation that the company achieves is when you look at monthly closing stock prices. Now, this orange line is a PE of 15 with some cyclicality, as I mentioned. So I do want you to notice, you see, to me, a lot of volatility in this stock where you see the prices, having some very strong peaks and valleys or peaks and troughs, which is something you need to be aware of. It does react to, market price does trend line with earnings growth. When earnings growth is good, we get pretty good advances with volatility in the middle. And the stock was recently, as early as 2017 and for a great part of 2018 and even coming into 2019, the stock was overvalued. However, its price has now fallen down to where the blended PE ratio is below 15 at 13. It offers a 4.3% current dividend yield. The company's a $3.8 billion market cap with only 14% debt to capital. One of the things I like about this company is that it does have a very strong but also flexible balance sheet. And historically, the company has not been afraid to exercise its balance sheet muscle to make acquisitions and/or reward shareholders with nice dividends and/or dividend growth. Now let's look at their dividend record very, very quickly here. I'm going to bring up the dividends with the dividend payout ratio. Now, they did pay a special $3 dividend in 2015, but I want you to notice the real consistency. And if you can kind of mentally close this gap here, you can see that they've increased their dividend quite nicely year after year after year since they started paying one in 2003. If you look at it from a standpoint of performance, their dividend growth has been exceptional, averaging over 57% a year. But again, that is, pretty heavily skewed by the fact that in 2015 they paid a special $3 dividend. Otherwise, their dividend went from 132 to 160 to 172, excluding that. And this is not a dividend cut. This is simply a reduction from the special dividend that they paid. Their actual dividend really did increase during this time. If you compare investing $10,000 in this company at the end of their fiscal year 1999 or August 31st, a $10,000 investment would have thrown off, since that time, almost $22,000 in dividend income compared to just slightly more than $3,900 in the average stock or the market. And $10,000 would have increased sevenfold to $71,000, averaging a 10.4% rate of return versus only 4% for the S&P over that time frame. So if you kind of look at this, I think it's important to recognize that the company's long-term growth was pretty much equaled their earnings growth, but it was also a result of it being moderately undervalued overvalued at the beginning and moderately undervalued here at the end. In the middle is what I want you to be focused on. Now, the company has paid, again, these great dividends, and they've thrown off this special dividend. So it's a really good dividend producer if you can withstand the volatility of looking at this stock. So to me, this investment is really all about the dividends. Looking at forecasting just for a moment, we're expecting a flat year this fiscal year, which ends again at the end of the month. And then we won't hear about it, though, for another 45 days. And then most analysts, and there are 14 analysts that are reporting, expect the company to be rather soft again in 2020. But there are reasons why analysts do expect a resurgence of growth going beyond that. Now, interestingly, the long-term growth is forecast to be around 15% going forward. Now, I like to compare that with other sources. This is from FactSet, so I'm going to look at Yahoo here. And Yahoo only expects earnings growth to average about 3.6% over the next 5 years. So I want to throw that out there because I want you to understand this company is rather difficult to estimate earnings and growth. Historically, because of the cyclical nature, they've missed 1 year forward earning estimates by 40%, even with a 10% margin of error, and they've missed 2 year forward forecasts by 20% for a margin of error. But having said that, as I examine their earnings history, even though they've missed estimates at times, the company has remained profitable through 2 recessions, and it's actually grown their earnings at a pretty attractive rate. But to me, a stock like this is all about the dividend, and when I'm thinking about the dividend, I want to then look at operating cash flow. Now, the company has low debt and a very strong balance sheet, as I mentioned. So the first thing I want to look at is operating cash flow covering the dividends, and they've got really excellent operating cash flow coverage. I don't even care really much about price as I'm looking at this, although price to operating cash flow is a pretty good valuation metric. I shouldn't say I don't care about it, but what I'm mostly focused on here, do I have operating cash flow that's, covering the dividend? And then the final acid test for me is to look at free cash flow. And this company's been a very prolific producer of free cash flow going back to 2002, as you can see. And their free cash flow has significantly covered the dividend, which gives them a lot of flexibility to continue paying their dividend as well as rewarding shareholders in other ways. So I really like this company for the income capability. I don't like this company from its, moderately cyclical nature. But if I look at EBITDA, which again is another form of cash flow, and then value the stock based on that, the company historically trades at about 11 times EBITDA. That's what the orange line on this graph is trading at. It's currently trading at 8 times EBITDA, which would indicate, a very attractive opportunity going forward. So if you're going to invest in a cyclical like this, buying it when the valuation is low makes a great deal of sense to me. Based on returns, based on it moving back to a more normal price to EBITDA, and I'll go ahead and add that normal price to EBITDA we were looking at historically of about 11 onto the graph here to kind of give a reasonable estimate of what our returns might be. We could generate very, very strong total returns out for the next couple of years, which is about far as I like to go. And all I'm suggesting here is that even with relatively flat growth, if we get a reversion to the mean, and that could happen in 2021, if we actually do get a little surge in EBITDA growth of, let's say, double-digit surge in EBITDA growth, then you could very well see, 35-40% rates of return. And you can measure that kind of return potential using other metrics as well. If I move back over here to adjusted operating earnings and looked at normal valuation multiples, let's take a look at that. Let's look at the normal multiple historically has been about 20. But I want to be clear about when I'm using numbers like this. This is a reference, okay? And you can clearly see times when the multiple has been much higher than that 20. You also see periods of time where the multiple is less than that. So when you're looking at things like this, when I'm looking at forecasting using the normal multiple, I'm using the 5-year normal multiple of 18. I could pick other higher numbers here like the 20 multiple that we saw with the longer term graph, or I could even go and pick the lowest normal multiple, which has really been the last year, and apply it to the graph. And so even if I apply this 16.8 multiple, I still would have very, very attractive rate of return, total rate of return expectations with, good dividend growth expected to continue. So this is not necessarily everybody's cup of tea. It's a moderately cyclical industrial. I do think the company is very attractively valued right now, and this is one of the best valuations I've seen on this whole graph. I think the company's got a lot of good things going for it. It was overvalued, for the last couple of years, and which made it less than optimum. If I look at it from a dividend yield, exclude this one here because that's where they paid the special $3 dividend I mentioned. The company is, last year it ended with a dividend yield of 3.8%. It's currently slightly higher than that at 4.36, which is literally the highest dividend yield that you could have, bought the company on a current basis at over this history going back to 2002. So that to me tells me that, this is a very attractively valued mid-cap dividend growth stock with little debt. It's not rated by S&P currently, but it is one of the leaders in a very fragmented industry, and it does have some intriguing opportunities. So if you like this, you might want to take a closer look at MSC Industrial Direct Company. And also if you like this video and like what we're trying to express here in these videos, I'd suggest that you subscribe to our YouTube channel. And you also might want to take a closer look at the Dividend Kings as a subscription site, because this is one constituent of our blue chip high yield portfolio. And then of course finally you might also want to take a look at subscribing to Fastgraphs if you like to run your own money. Anyway, this has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video.